In June 2020, a German payment company admitted that 1.9 billion euros, roughly a quarter of its total assets, probably didn't exist. Not missing, not misplaced, probably never there at all. The company was Wirecard. It had been audited every year for 9 consecutive years by Ernst & Young, one of the most prestigious accounting firms on the planet. EY signed off every single time. Within days, Wirecard filed for insolvency. Its CEO was arrested. Its chief operating officer had vanished and remains a fugitive to this day. The stock lost 98% of its value in a week. This is not a story about one clever criminal. This is a story about an entire financial establishment that chose, repeatedly and enthusiastically, not to look. Wirecard was founded in 1999 in Munich, initially as a processor for online payments, specifically for adult entertainment and gambling websites. Not exactly the most glamorous origin story for a future national champion, but the internet was booming, digital payments were the future, and Wirecard moved fast. By the mid-2000s, it had pivoted toward mainstream e-commerce and was processing payments for legitimate retailers across Europe. In 2006, Wirecard acquired a listed shell company and went public on the Frankfurt Stock Exchange without a traditional IPO, an unconventional entrance. Fitting, in retrospect. Markus Braun became CEO and the face of the company. Tall, soft-spoken, always dressed in black, always holding an iPad. He positioned Wirecard not as a payment processor but as a technology company, a German answer to Silicon Valley. Investors loved the pitch, and the numbers seemed to back it up. Revenue grew year after year. The company reported expanding margins, global partnerships, and operations across Asia, the Middle East, and beyond. The story was compelling. By 2018, Wirecard was valued at roughly 24 billion euros, surpassing Deutsche Bank. It was added to the DAX, Germany's index of the 30 most valuable publicly traded companies. Germany had its own fintech unicorn. The financial press celebrated accordingly. There was just one problem. Journalists had been raising questions about Wirecard's accounting for years. As early as 2008, analysts flagged unusual entries. In 2015, a report accused the company of booking fictitious revenue. Wirecard called it misinformation. In 2019, the Financial Times published a series of reports based on internal documents. The documents suggested Wirecard's operations in Asia, which reportedly accounted for a substantial portion of the company's profits, were either fabricated or heavily inflated. Wirecard's response was aggressive. The company threatened legal action against the FT. Its supporters accused short sellers of market manipulation. Germany's financial regulator BaFin launched an investigation, not into Wirecard, but into the journalists and traders who had questioned it. Let that land for a moment. The regulator investigated the people asking questions. Wirecard's stock actually recovered. The company raised fresh capital from institutional investors. SoftBank invested 900 million euros in early 2019. This is the part of the story where the word fraud starts to feel too small. What Wirecard had built was an ecosystem of belief, and everyone with money in the game had a reason to keep believing. The mechanics of the fraud centered on a concept called the third-party acquiring business. Wirecard claimed to process payments in regions where it lacked the necessary licenses by using partner companies, primarily in Asia and the Middle East. These partners supposedly held vast amounts of Wirecard's cash in escrow accounts, specifically, accounts at 2 Philippine banks. The 1.9 billion euros in question was allegedly sitting in those accounts. It was not. Both Philippine banks confirmed they had no record of the accounts. The trustee Wirecard identified as managing the funds denied any such relationship existed. The money was, as the auditors eventually had to concede, gone, or more precisely, had never arrived. On June 18, 2020, Wirecard announced it could not publish its annual financial results because 1.9 billion euros was unaccounted for. The following day, the stock fell 61%. The day after that, Markus Braun resigned. On June 22, Braun was arrested by German authorities. On June 25, Wirecard filed for insolvency, the largest insolvency in German post-war history, with liabilities of approximately 4 billion euros. Chief Operating Officer Jan Marsalek, the man widely believed to be the operational architect of the fraud, fled the country 2 days before the insolvency filing. He has not been found. Interpol has a red notice. He has been reportedly linked to Russian intelligence services. The damage extended well beyond one company. Wirecard's collapse exposed systemic failures at multiple levels. EY, which had audited the company since 2009, admitted it had relied on confirmations from a Singapore law firm for the existence of the escrow funds, confirmations that were later found to be forged. BaFin, the German financial watchdog, was criticized by the European Securities and Markets Authority for its regulatory failures. A parliamentary inquiry found that BaFin had received multiple warnings about Wirecard and failed to act on any of them. The inquiry was, by German government standards, excoriating. German banks had extended Wirecard a 1.75 billion euro credit line just months before the collapse. A consortium of 15 banks, all of them doing their due diligence, all of them satisfied. Markus Braun went on trial in Munich in late 2024, one of the largest fraud trials in German legal history. He denied knowing about the full extent of the fraud, suggesting he too had been deceived by Marsalek. The trial is expected to last years. Meanwhile, the estimated 20,000 retail investors who held Wirecard shares lost the overwhelming majority of their investment. Many had bought in after the DAX inclusion, precisely because the institutional validation made it feel safe. So here is the lesson. Wirecard survived exposure not because it was clever, though it was, but because the institutions around it were structurally incentivized to validate it. Auditors get paid by the companies they audit. Regulators face political pressure to protect national champions. Banks earn fees on the deals they approve. The fraud didn't fool the system. The system was the fraud's best defense. When the Financial Times, a newspaper, not a regulator, not an auditor, finally forced the reckoning, it did so against active institutional resistance. That should be the uncomfortable footnote every finance professional carries. The next time a company is called uninvestable by the press and a national disgrace for asking questions, remember Wirecard. Remember that Germany's DAX flagship, worth $28 billion at its peak, was built on accounts that 2 Philippine banks said they had never heard of. If you found this story disturbing in the right ways, the Verano's collapse is waiting for you, and somehow it's worse. Subscribe for more hidden empires.